I'm going to share with you the very best way I know on how to save, protect, grow, and use your money throughout your life, all without having to choose between one or the other. My name is Guilliams. I'm the founder of BetterWealth.com. Our mission is to help you live more intentionally by bettering your wealth. And one of the best ways that we can help better your wealth is helping you be more efficient with how you're saving and using and growing and protecting your family. This book I wrote almost 10 years ago. It's called The And Asset, How to Give Your Dollars More Than One Job. And since we've written this book, we've not only sold over 20,000 copies and spoke around the country and have thousands of YouTube videos, but we've installed over $2 billion worth of this strategy. And it's all around the premise of not trying to get better rates of return or trying to outperform certain things. It's all around the premise of how do we give $1 more jobs and how we can actually better what you're currently doing. And so that is the whole reason why we put this masterclass together, is to have this be like the most comprehensive place. And at the end of the day, you can answer the question, is this something that I want to pursue? Because we'll show you exactly at the end of this presentation how you can work with our team to answer the question, is this actually going to help me? Because if it is, we'll show you. And if it's not, we'll tell you. But the reason we're putting this comprehensive presentation around is because we have lots of videos and all, we get hit up all the time to be, where do we start? Well, step number one is watch this presentation. Hopefully it answers a lot of questions and it helps you have confidence around this is something that I actually want to pursue, or it might do the exact opposite. You might have confidence to say, this is not something that I want to do. And as a result, we don't want to waste your time in doing something that's actually not going to better your financial situation. Now, as I share this, I want to take a step back and share with you my thesis, because if you don't get anything else in this whole presentation, I want you to get this concept, because this concept will help you when it comes to your money. And the concept is around wealth efficiency. It's my belief that you should want to lean in and be as efficient with your wealth as possible. But to be wealth efficient, we need to define both of these words. So what is wealth? If I were to ask you what is wealth, and if you write down, a lot of people write like freedom, they'll write down maybe net worth, they'll write down retirement, they'll write down, I get lots of different answers. And I'm going to share with you a picture of what some people would call the world's wealthiest man. Warren Buffett. A lot of people know him. He's worth over $100 billion. And he's also over 95 years old at the time of this recording. And I ask people as I speak around the country, would you trade places with Warren Buffett? And most people say no, because they value their family. They value their life. They value what they're doing. They wouldn't actually trade places with over $100 billion for the simple reality that they value their life. They value what they're up to. And so what that tells me is we value way more than just net worth and cash flow. Wealth is so much more than that. And so our wealth metric is very simple. You're not living wealthy if you're not living intentionally. So in other words, our wealth metric is intentional living. Our vision as a company is to make intentional living the new wealth standard. In other words, you're not wealthy if you're not living intentionally. So no matter what company, whether it's us or someone else, if we're not helping you live more intentionally, you should not work with us. The exact opposite is true. If something can help you live more intentionally, you should lean into that, because of that being the definition of wealth. So wealth is getting really clear on what you want. And ultimately, that's your version of intentional living, which is beautiful, because your version of intentional living might be different than mine, which that's life. We all value maybe different things, and we should be pursuing those things and really holding that higher than maybe what other people want us to do. All right, now we're going to talk about efficiency. Now, there's a lot of different definitions of efficiency, but my favorite definition is the ability to avoid wasting materials, energy, efforts, money, and time in producing a desired result. In other words, to be efficient, you need a desired result. Well, that's intentional living. We want to know where we want to go, and then we want to eliminate any friction that's getting in our way. And regardless of whatever you think of like in financial planning, financial strategies, what it really should entail is getting really crystal clear on where you want, and then eliminating anything that's possibly in the way, any friction that's in the way to accomplish what that is. Now, the example I'll give is I live in Nashville, Tennessee, and if I wanted to get to Arizona, I'm really clear that that's where I want to go. In fact, a lot of people are unclear where they want to go. So this is actually better off than most people when it comes to planning, is I actually know where I want to go, but I could walk to Arizona and it would take me almost 45 plus days, probably over 45 days. Not very efficient. It's not saving time. It's a lot of money and it's a lot of energy. And I mean, there's a lot of reasons why I wouldn't want to do this. Now, I could also drive from Tennessee to Arizona, and that would be so much more efficient. I could get there in 2 12-hour days. And yet I've never made this drive, but I've made this flight, many times a year. Why? Because it's not only cheaper to make that flight, but it saves me so much time. And it is by far the most efficient way today to get from Nashville, Tennessee to Arizona. And that's why I and many other people would choose the flight in this option. The reason I share this is obvious. If someone had the ability to get from Nashville to Arizona, they would most likely fly. And yet when it comes to a lot of people's financial lives, many people are choosing to actually walk or even drive to their destination instead of fly. We see this all the time when it comes to people's finances. And so we want to be as efficient as possible. In other words, better for us equals wealth efficiency. So anytime we say the word better, we want to think about helping you live more intentionally by removing as much friction to live that as possible. Now, there's a lot of different keys to helping someone better their financial life. Make more money. We could save more, which is obviously there's so many great strategies in helping people save more. Tax strategies, paying off toxic debt, being really clear about where you're valuing, how you're spending your money. We could show you how to get higher returns. There's tons of people that have different investment strategies. In fact, I have different investment theses, and there's a lot of interesting things that we're doing. And if you follow us on our YouTube channel, we interview people that are doing interesting things. And so we could obviously help people make more. We could help people save more. We could help people have higher returns. And none of these things are bad. But what we've chosen to do as a company is we want to be the company to give your dollars more jobs. And I just want to acknowledge like all these ways are able to help you, but we as a company are saying we're going to specialize in helping you give your dollars that you currently have more jobs, and as a result, helping you be more efficient, removing friction to better your outcomes. All right, so question for you. If you could give your dollars more jobs without taking on more risk, could you get better outcomes? Now, the example I'll use is many people watching this have a smartphone, but I would bet you almost everyone that is watching this masterclass has a smartphone. But some of you watching this may also have a landline or what I call a dumb phone. And it's interesting because both of these are phones. They both can make calls. In fact, the landline might be able to make better calls depending on where you're at. It might be more reliable for that one job. And yet the smartphone is way more popular. More people have it. And yet, even though it's way more expensive, we don't even think twice about paying more for a smartphone. Well, why? Because our smartphone does so many more jobs for us. It's almost like a disrespect to call it a phone because it's your phone. You can text on it. You can calculate things on it. You can take pictures. You can be on social media. You can email. Like there's so many jobs that you can do. Whereas the landline phone does one thing. And as a result, we as a society value this smartphone doing more than one job for us. And we inherently understand that even though it's the same phone, it's way more valuable than what some people call a dumb phone. Now, I got two questions for you. How many jobs are your dollars doing for you today? And then how well are they doing those jobs? I'm going to share with you a couple of examples just to get our mind going. So example number one is a checking account versus savings. Okay, many of you probably have both, a checking and a savings, but why not just have one? Well, a checking and savings are both safe. They're both liquid. Checking account might be more convenient than a savings account, but the reason why most people have savings accounts is that it gets you a better growth rate than a checking account. In a lot of cases, checking accounts give you zero, whereas savings accounts give you something more than zero. So that's why we have savings and checking account. It comes down to the jobs that it does for us. Now, let's look at the difference between a brokerage account versus a Roth IRA. Most of you might have both of these. Now, brokerage and Roths, the purpose is that they grow, but Roths can give you some amazing tax benefit. Your money can grow without paying taxes. It can grow tax-free and gives you special creditor protection, whereas most brokerages don't give you that. Now, Roths do have contribution limits. In some cases, people aren't able to qualify for them. And so brokerages have a value because you don't have any contribution limits. So people can put a ton of money in, but there's a lot of benefits to Roth. And if you can do a Roth, obviously there's advantages there. And so that's the difference between a Roth and brokerage. It just comes down to Roths give your dollars more jobs. And as an asset or wrapper, it can be really valuable. Real estate is a really popular asset class that a lot of wealthy people have their money in. Well, why is real estate so valuable? It grows. It can create cash flow. It can give you amazing tax benefits. You can use competitive leverage and you get step up in basis. Well, typical investments, the hope is that it can grow. It might create cash flow. And while most typical investments have step up in basis, you just compare the jobs that real estate gives to your dollars if done well. Real estate tends to be a better investment than just a boring typical investment. Hence why there's trillions of dollars in that asset class. Debit versus credit cards. There's nothing wrong with using a debit card, but most savvy people use credit cards. Why? Because of fraud protection, because of purchase protection, because of rewards and cash back, because of extended warranties, because of building their credit, because of convenience, and because they get a 30-day float. Actually, ironically, most people would still use credit cards even if they didn't get a 30-day quote because there's so many other benefits of using a credit card versus a debit card. A debit card can give you some of those same fraud protections, but a lot of those benefits just don't hold a candle to what credit cards can give you. And so that's why many people use credit cards, even if they pay off their credit cards every single month because of all those benefits. Now, The reason I'm sharing this with you is I want to prove to you that you're already thinking efficiently. Like the reason you have a smartphone is you get this idea of multiple jobs. And the reason why you do things like have credit cards and understand the power of real estate and might prefer a Roth over a brokerage account and maybe a savings over a checking account is you understand this idea of giving your dollars more than one job. And so what I want to do is I wanted to put together something that doesn't exist. But if it did, I wanted to put a perfect asset together. And if we could brainstorm like what a perfect asset would be, it would have all these jobs, it would have green check marks for every job. All right, let's talk about this perfect asset. Number one, it would be completely safe. It'd be easily accessible. You'd have competitive growth. Not only would it have competitive growth, but it would grow the rest of your life. It'd be flexible. You'd have a leverageable option. You'd have guaranteed no losses. So what we're essentially saying is it'd be safe. It'd be easily accessible. If competitive growth, it'd grow the rest of your life. It'd be flexible. You'd have the leverageable option and it would be guaranteed not to lose. Like obviously in a perfect asset, that would be key. Would have no percentage-based fees that you would have to pay as your balance continues to grow. It'd be totally private. You'd have no contribution limits. It would be creditor protected, of course. You would have tax deductible contribution. So money going into that would be tax deductible. It would grow tax deferred. You could have tax-free access. It would have long-term care and protection, and it would have some type of legacy. Obviously, I hope you're laughing because this asset does not exist. But if we had to paint a perfect scenario, this would be the perfect asset. Perfect asset in a lot of cases would check all these boxes. Now, because the asset that we're going to be talking about today is not perfect, it does not check all these boxes, but it checks a lot of them. It's safe. It's easily accessible. I'm giving a yellow competitive growth. I will explain in a second later in this presentation what that exactly means, how we actually calculate the math. I think it's phenomenal growth, but just to be fair, I'm giving that a yellow. It grows the rest of your life. It's flexible. It's a leverageable option. You're not going to lose money. No, you don't have to pay percentage-based fees. It's private. No contribution limits, creditor protection. You don't get tax deductions of contributions going in. But once in, your money grows tax deferred. You do have tax-free access to it if done properly. You have a version of a long-term care protection. It's not quite long-term care protection, but it's a version of it. And it's one of the greatest legacies out there. Now, what is this boring asset? This boring asset is specially designed, overfunded whole life insurance. Now, for many of you, this is no secret because you've watched a lot of videos, you've seen my book and you've seen me speak. But for some of you, you might be thinking, life insurance? Like life insurance? I usually get two responses when I talk about life insurance. Someone's like, man, this is really awkward. Where's the door kind of deal? Or it's the people out there that want to tell me life insurance is the worst place in the world to put your money. Like, have you heard what Dave Ramsey or Ramit Sethi have said about life insurance? Like they just think life insurance is a complete scam. And I just want to give a quick disclaimer. Most life insurance policies are not designed well and will not be able to accomplish all of what I'm going to share in this presentation. In other words, the last thing I want you to do is to go get life insurance based on what you're seeing in this presentation because most life insurance is not optimized and set up to do this. And in fact, at the end of this presentation, we're going to share with you all the top criticisms, all the top questions, and we're going to address Dave Ramsey's and Ramit Sethi's and other people out there that say like life insurance is a total ripoff. We're not only going to agree with them at the end, we're going to share with you why in many cases they are 100% right. And that's why I'm putting together this comprehensive presentation because I can't just say do one thing without actually laying out exactly why we're doing what we're doing, how we're doing it, and what exactly we're doing. So we're talking about life insurance. We have to take a step back and say there's actually been presidents on both sides of the aisle that have heavily used this asset. There are banks. There's over 3,200 banks today in the United States that have billions of dollars of tier one capital in this. In fact, Chase Bank has over 12 billion, Wells Fargo has over 19 billion, and Bank of America has over $22 billion with a B of their tier one assets in bank-owned life insurance. Many Fortune 500 companies have used life insurance to key team members and employees. My friend Gary Gunderson wrote the book, What Would the Rockefellers Do? And this book lays out how the Rockefeller family used life insurance and trust to keep more money within their family and how every generation they get wealthier and wealthier using life insurance. My friend Justin Donald, who wrote The Lifestyle Investor, talks about how he uses life insurance to acquire investments and businesses. My friend Tom Wheelwright, Robert Kiyosaki's CPA, wrote in his latest book a whole chapter dedicated to life insurance and how life insurance, when done properly, can be an amazing tax haven to save and use your money throughout your life. Ed Slott, known as the IRA expert, has talked a lot about how life insurance can be used in retirement planning. Dr. Wade Fall, one of the most respected academic experts when it comes to retirement planning, is a big fan of using life insurance in retirement planning. Tom Wall, who has a PhD in retirement income, wrote a book called Permission to Spend, which is all around this strategy. Even Ernst & Young did an independent study that said insurance and investments mixed together can create a greater outcome than just one or the other. Why am I sharing all these things? I'm sharing this because while life insurance has been misused and misoversold and overpitched, it as an asset class, when done properly, can be incredible. And I'm not going to let the misunderstandings or because life insurance has a bad rap, not to share with you why I believe when set up and used properly, it can be one of the greatest assets out there. Because again, it's not going to outperform investments, but if you take a step back, it can help you be more efficient because of the jobs that's able to do for your dollars. And if you're able to apply those jobs, you will ultimately have better options in the future. All right, this next slide has a lot going on, so let me unpack this for you as simply as possible. I'm showing you a traditional IRA, a Roth IRA, a savings account, and overfunded life insurance. And I'm simply asking the question, what would it check the box as it relates to each one of these benefits going down? From safety, easily accessible, competitive growth, lifetime, compounding, flexible, leverageable option, guaranteed loss, no percentage-based fees, private, no contribution limits, creditor protections, tax deductible contributions, tax deferred growth, tax free access. I'm changing this from chronic and terminal illness because that's a check that every insurance policy that we work with checks the box, and every insurance policy we work with has a death benefit. So I'm changing legacy to death benefit. Now, I want to be very clear. I am not saying that overfunded life insurance is better than a Roth IRA. I'm not saying it's better than a traditional IRA. I mean, I'm not even saying that's better than a savings account because every one of these have a place in a strategy and in a portfolio. And I would never say that one is better than the other. But I am saying that life insurance in many cases, whether you're want to optimize retirement, whether you want to be an amazing entrepreneur, whether you want to pass on a great legacy, in all three of those scenarios, life insurance can play a phenomenal role when it comes to helping you better your financial situation. So while I'm not saying more check marks automatically mean better, you'll see very soon that life insurance is not a replacement for an investment. I would never sell it to say that this is better than investment. In fact, I just think it's an enhancer to what you're currently doing investing. I wanted to show from a checkmark standpoint that when designed well, it can be a phenomenal and asset, as I would say. It's an and it enhances a lot of the things. So that's what I'm saying here. I'm not saying that overfunded life insurance is better than all these assets. I'm just saying that it should at least be part of the conversation when we're talking about all of this. We believe that if you're in the top 50% of Americans, then a specially designed life insurance policy could improve your overall financial strategy. So this is not a silver bullet. This is not going to save everyone's financial life. If someone is overwhelmed with debt, is not making any money, has no money to begin with, this strategy is not going to be the thing that they should focus on or going to be moving the needle. This is really for the person that's starting to make money, starting to have money, and starting to ask the question, how can I optimize what I'm currently doing? In this presentation, we're going to go through Life Insurance 101. You will be an expert around life insurance at the end of this presentation. We're going to talk about overfunding a policy versus a typical policy and going to get into real numbers. We're then going to get into pros and cons of the strategy. We're going to get into case studies, entrepreneurial investor, if someone's more entrepreneurial or a business owner, how they can use life insurance, a retirement optimizer, someone that wants to optimize retirement, like they want more certain income, more options in retirement. We're going to talk about that, and legacy maximizer. We're going to talk about how someone could maximize their retirement using this life insurance when set up and used properly. And then finally, we're going to talk about the criticisms and questions. And by the end of this presentation, you'll quite frankly be able to answer a lot of the criticisms as well, because you'll just understand the framework and how we're thinking as relates to insurance. Okay, what is life insurance? Life insurance is a contract between you and an insurance company. And not all insurance companies are created equal. Not all contracts are created equal. So let's first talk about companies. It's important that we're working with a mutual company. In other words, we want to have ownership stake in this company. We want this company to have great ratings, and we want this company to have a very long track record. Now, when it comes to insurance contracts, there's permanent insurance contracts, and then there's term insurance contracts. And many of us have heard of term insurance, and there's a common phrase, buy term and invest the difference. Well, that's what you're essentially doing, is you're buying a temporary contract and you're investing the difference. So temporary is pretty self-explanatory. It's not meant to last forever. And in a lot of cases, it will 10, 20, or maybe even 30 years. But after that, it doesn't necessarily make sense to renew. So that contract is temporary after 20 or 30 years. A permanent contract is lifelong. It's designed to last your entire life. Now, there's two types of permanent contracts. There's whole life and IUL and VUL. Now, whole life is safe, it's guaranteed, but you have less upside, whereas IUL is less safe. There's more moving pieces, but there's a potential of future upside. Now, I'll be very clear. We believe that life insurance is not an investment. And so we don't want to even flirt with the idea of putting money in something that potentially performs better than investments. And so most of our clients choose the whole life route because of what I'm sharing with you. We want to be efficient. We want to be foundational asset. We want to enhance other assets. And so for that reason, most of our clients use whole life, but the idea of specially designing a contract can apply to both. I just wanted to be as upfront with you as possible that majority of the clients that we work with choose to do all of what I share with you through a whole life chassis versus an IUL and VUL chassis. Now, I use this example because we say a lot of times life insurance is not an investment. And while your phone does so many things, I ask people, is your phone an investment? And actually, a lot of people will say yes, but it's really not, because you're not looking at a statement and saying, what is my rate of return that my smartphone is getting me each month? It's not, but yet your phone does so many jobs for you, and you're able to, quite frankly, invest better because you have a phone, and run your business better because you have a phone, or be a better team member because you have a phone, and be more productive, save more money because you have access to this technology. And so while it's not an investment, it directly can enhance what you're currently doing. And we think the same way around insurance. While your insurance is not an investment, it should enhance everything else that you're doing because you have it at the foundation. And as a result, a lot of people, when they talk about insurance, they're trying to make it be the thing. They're trying to badmouth everything else. We do the exact opposite. We think that what you're currently doing is probably amazing. And if it's working great, can we enhance what you're currently doing? And if we can't enhance it, then you probably shouldn't do it. Now we're going to talk about overfunding versus typical policy. This is where designing your contract matters. And a lot of people, when they badmouth insurance, are actually badmouthing how insurance is designed. So let's talk about the 3 different ways you can design a life insurance. First of all, if you're designing a term policy, your goal is very simple. It's pay as little as possible, get the maximum amount of death benefit for that time period. So if you're trying to get $1 million worth of coverage, you're trying to pay as little money as possible to get that $1 million worth of coverage over that period of time. Whoever will give you the cheapest, you're going to go with. The second type of policy design is to maximize legacy focus. Your goal is to maximize the death benefit legacy upon your future death. And so there's a lot of different ways that you can strategize that, but you want to figure out, how can I pass on the most amount of money to my estate? The third way to design a policy is to maximize the living benefits. And the goal here is to maximize the living benefits for the owner while the insurer is alive. So in other words, how can I benefit while I'm alive with my life insurance policy? While we work with people with all 3 of these strategies, what we're most known for is number 3, maximize the living benefits using permanent life insurance. All right, so what I'm going to share with you next is a typical policy and an overfunded policy with the same insurance company. And actually, the insurance company is a great insurance company, but what we're doing is we're showing you a typical design, which is 98% of the time of what we see is being done around this typical design framework. And then we're going to show you an overfunded design. And this overfunded design is not even optimally overfunded for maximum cash value, but we're just switching a few things, and you're going to see radically the difference. And the reason we share this with you is we think it's important for you to understand what you're dealing with, because when someone says life insurance, there's a broad spectrum of when people use the word life insurance, and not all life insurance is created equal. All right, so let's look at typical whole life. Now, typical whole life has what's called a high base, which means that $50,000 example that we're showing you, you have to pay $50,000 every single year in this example. You get little to no cash value early on. This is probably one of the biggest pushbacks that people give you is whole life insurance or even IUL. You get 0 cash value in the first couple of years. It's like, in this case, you're putting $50,000 in, you're getting 0 cash value in the first year. You're putting $50,000 in again, you're getting 0 cash value. You're putting $50,000 for the 3rd year, and you're finally getting $25,000 that you can utilize. That, for a lot of people, feels like a total ripoff. It's not, because your permanent death benefit is almost $4 million and growing. I can understand how that feels not flexible. Like, you need to pay that $50,000 every single year, and until you have enough cash value in your policy, you're on the hook for that. It takes over 10 years to break even. In a lot of cases, this breaks even in 12 years, but in a lot of typical whole life insurance policies, it doesn't break even for 20 plus years. So when people say it's got terrible growth, it barely breaks even, they're not wrong. In most cases, they're 100% right. The growth is terrible. Like, in a lot of typical whole life insurance policies, the growth won't even break 2%. And these ironically pay the highest commissions. And so again, I want to be as upfront with you as possible that just because I'm a fan of specially designed life insurance doesn't mean I'm a fan of all life insurance. Now, when we talk about overfunding life insurance, we're talking about minimizing the death benefit and maximizing the living benefits. So we're trying to make the death benefit as artificially small as possible in this scenario and maximize all the cash benefits that we get to not just be good today, but grow in the future. All right, let's talk about overfunding. This is the same exact contract. So all we're doing is we're taking the same company, we're taking that same contract and tweaking a few different things. I want to be very clear. I'm not even saying that this is the most optimal way to design a policy. We're just tweaking a few things with the same contracting company. Okay, so we're adding a PUA rider. We're adding what's called a term rider. We get a lot of earlier cash value. We get way more flexibility. We get way better long-term performance. This pays a fraction of the commissions the other one paid. And the death benefit increases a lot faster. In fact, the death benefit over 30 years, it surpasses the original typical policy. So the typical policy's claim to fame was it's a higher death benefit, but this death benefit passes it up over 30 years. And instead of having cash value of 0 in the first 2 years, you have $39,000 of cash value available in year 1. You have over $82,000 available in year 2. This, instead of breaking even in year 12, breaks even in year 6, meaning you have more money than what you put in after 6 years, and is a lot more flexible, meaning $50,000 is what we're showing, but you don't have to pay anywhere near $50,000. So you have a lot more flexibility, but the performance of cash value just is way greater. And so the reason I share this with you is just to say not all life insurance is created equal. And even you could be with a great company. I see lots of people that say, I'm with a great company, and they're right. They are with a great company, but their contracts are not designed to be optimal. So while they were sold a lot of the benefits of insurance, the way that it was designed and set up wasn't optimal for what they were sold for. And so this is just important to understand the difference between typical and overfunded style policies. Now, let's talk about the pros and cons of life insurance. Now, the pros is something I've been pretty clear about. When set up and used properly, and I use the word specially designed because not all life insurance is created this way, but if it's specially designed, it's going to be safe. It's going to be easily accessible. It's going to have competitive growth. I'm going to share with you in our case study how the growth actually works, and it's really, really good. But to be fair, it's not an investment, so I made it yellow. It's going to grow the rest of your life, which is going to be really key when we're talking about retirement planning. It's flexible. It's extremely flexible. A lot of times people think life insurance is not flexible. It's very flexible when designed properly. You have leverageable options, which we'll talk about in a second. You have guaranteed, especially when we're talking whole life insurance, there's special guarantees built around not losing money. There's no contribution limits, meaning there's no government regulator saying you can only put in X amount. I mean, we have clients that put hundreds of thousands, if not millions of dollars in per year, their life insurance contract, because there's no, again, government contribution limits. Every state has creditor protections with life insurance. Some states it's 100%. Some states it's less than 100%. When it's set up and used properly, your money will grow tax deferred in your policy. You can access your money tax-free. You have chronic and terminal illness benefits to it. So essentially what that means is if there's certain things that happen to you health-wise in the future, you'll have the opportunity to potentially pay down your death benefit. If you qualify for the chronic and terminal illness, you'll be able to spend your death benefit while you're alive. And then you have a death benefit, which is obviously great for protection, but also pays income tax-free and is great for legacy. So these are the checks that you get when you have the pros of life insurance. All right, let's talk about the cons of life insurance. Your contributions are not tax deductible. It takes over 4 years to break even, and not everyone qualifies health-wise. So let's first talk about number one. The premiums going into a life insurance policy are not tax deductible. And in some cases, you might say, well, I've heard people use strategies where they use life insurance and deduct their contributions. If that's the case, you lose some of the other tax benefits that I said as pros. And so for most cases, I would say 95% of the people that we see choose to not deduct their contributions going in. And as a result, it's not tax deductible. It's very similar to like a savings account or Roth IRA. The second thing is you don't have all the money immediately available in day one when you fund your policy. And in a lot of cases, it takes over 4 years to have more money than what you put in. Some people really get bothered by this. They want all the money immediately to be able to use. And if that's them, this is a strategy that's just not going to be the best for them. They should stick to a checking or a savings account to save their money and then utilize it to do whatever they want. Life insurance, even the most efficient life insurance policies, you're going to have a few years where you have a little less money than what you put in. What that essentially means is if you cancel within year 1, 2, 3, or 4, you might have less money than what you put in. Obviously, you should not be canceling, period. And so if someone even is thinking about canceling policy within a couple of years, we would say, don't even think about the strategy. And then the third con is a real con. Not everyone qualifies health-wise. And we've had people that really want life insurance. They really want to do this. They want to insure their life and they can't. There's ways around this. Like we can get insurance on your spouse, on your kids, on your grandchildren, on your business partners. But some people aren't actually able to get life insurance on their life. And that is obviously a con when it comes to this. And some people would say it's so good that you actually need to qualify with your health as well. And so these are your cons versus pros. All right, we're going to get into 3 case studies: the entrepreneurial investor, the retirement optimizer, and the legacy maximizer. And remember, the key to better is, does this better my life? Okay, so it doesn't matter how many jobs you can give $1. If it doesn't better your financial life, then don't do it. The first strategy we're going to look at is the entrepreneurial investor. And when I started learning about the and asset strategy, this was the concept that really drew me in, because even though I wasn't an entrepreneur at the time, I was thinking entrepreneurially, and this just made sense. And for many entrepreneurs that we serve, like, this is how they use their life insurance policy. So what most entrepreneurs do is they're making money and they're putting money into a savings account, and they're utilizing that money to buy businesses and investments, real estate, and do whatever they want. So they're making money, putting in a savings account, and then that savings account, they're taking that money out and putting it into all kinds of investments. Now, pros to a savings account: it's safe, liquid, convenient, gives you some growth. The cons, though, is it's actually low growth, it's not tax deductible, does not grow tax deferred, and you don't get great creditor protection. So while there's benefits, these cons also can compound over time. Now let's see if we can do this whole entrepreneurial thing better. You have your person, you're making money, and instead of putting all your money into a savings account, you're putting some of your money into an overfunded whole life insurance policy, getting all the benefits of insurance, but using your capital to buy businesses, invest in investments, buy real estate, or to do whatever you want. In other words, we're doing the exact same thing. The only difference is, instead of putting all your money into a savings account, putting some of your money into an overfunded whole life insurance policy. Now, we already talked about all the pros, and then obviously the cons is contributions aren't tax deductible. It takes a couple of years to have more money than what you put in. And obviously you have to qualify health-wise if you're going to be the owner and insured of your policy. But there's a lot of benefits to this. And in fact, over time, this could be hundreds of thousands of dollars difference just on the growth aspect. We're not even talking about all the other benefits you get with life insurance. Now, here's what I want to challenge. Early on, I said that life insurance competitive growth is a yellow check mark. And I did that to be fair, because I never want to try to overskew life insurance being the end all be all asset. Even though in this presentation, you might think like, wow, like that's exactly what Caleb's doing. I want to be as fair as possible. So this is an example of the overfunded life insurance policy that I shared earlier in this presentation. So you can see the $50,000 contribution is the contribution assumption. The cash value is, you can see, continuing to grow. This is the cash that you would have available to use throughout your life. The IRR stands for internal rate of return. This is the actual cash on cash return that you're getting over that period of time. So early on, if you canceled your policy within the first couple of years, you would obviously get a negative return. And then over time, you can see that the rate of return is greater. And then the death benefit starts at 1.3 million and goes all the way to 5.8 million over 30 years. Now, a common misconception is when you look at these rate of returns, you could make the assumption that you're only earning it in that year. For example, year 30, 4.58%. It's not that you're just earning it in that year. That's representing you're earning 4.58% every single year. I've showed a rate calculator to prove that point. All right, we're going to take this 4.58% over to our internal value calculator. Now, I want to be very clear. This 4.5% return is not any home run. It's not going to be a great investment. And in fact, a lot of you are watching this and like, well, no wonder, like, I'm not getting that excited when I take a look at this. And I believe life insurance, when set up and used properly, has a phenomenal rate of return. And I've designed this calculator to just show you, when you factor in other benefits that insurance gives you, that life insurance gets a lot better than a 4.5% return than it might show you. And again, I'm not saying that insurance actually gets you that on your cash, but when you factor in other benefits, you're going to see that insurance actually has a phenomenal rate of return. And so that's what I've done. We actually have this calculator. We'd be more than happy to show it on you with your custom numbers when we do an illustration based on your assumptions. So just know that these assumptions are basic, but that we can customize it as it relates to you. So if I just add a 30% tax bracket, 30% might be low for some of you, might be high for some of you watching this. Now the equivalent return that you would need to earn if it was competing with this whole life example, you would need to earn over 6.5% every single year. Okay. Now, what savings accounts out there are earning anywhere near 6.5%? There's investments that obviously are getting that, but savings accounts, you have to pay ordinary income tax on the interest. And so the equivalent value, your savings would have to earn over 6.5% just to keep up with the boring old life insurance. If we just stopped there, Most people would say that life insurance, just if you include taxes, would be far greater than any savings account that they could think of, especially over the next 30 years. But when you factor in cost of insurance, if you just factor in the term insurance cost of what it would cost, now you need to earn over 7%. If you just bought term insurance and put your money in a high yield savings account, you'd have to earn 7% every single year in that high yield savings account just to compete with the insurance. And then if you include a management fee, which if we're comparing it to a savings account, we wouldn't really need, but a lot of people now we could compare this to a bond or another type of asset. Now you're getting a life insurance policy. All we're doing is we're including taxes, insurance costs, and a 1% fee. And now in an equivalent asset, you would need to earn over 8% every single year just by including a few of the benefits that you get with life insurance. I want to, again, be very clear that life insurance does not get you 8.45%. But when you factor in some of these equations in the scenario that I showed you, you have to earn over 8% just to compete with some of those benefits. And I'm not sharing the chronic and terminal illness or the creditor protections or some of these other things just due to speed and simplicity. But again, this is something that we could do for you so that you can start quantifying the actual value that a life insurance policy could have if it's a part of your portfolio. All right, so we covered the internal benefits of a policy, and we even looked at how the equivalent value of a life insurance policy can increase when you start factoring in some of the other benefits you get with life insurance. So now let's talk about how you can utilize your policy. And this is actually one of the greatest advantages you have, but this is also something that a lot of people say, like, why do you borrow your own money? Like, that's really dumb for you to be able to do. And why would you borrow if you could just take your money out for free from a savings account? And I'll address all of that. And just to be really clear, this is exactly how you would borrow against your life insurance policy. And then we'll talk about why you would want to borrow against your life insurance policy. And then we'll answer the question, when does it make sense to borrow against your life insurance policy? So here are the 3 steps on how your life insurance works. Step number 1 is you're building cash value and you're getting all the benefits that you get with life insurance. So that's pretty self-explanatory. And I've pretty much shared that ad nauseum, the benefits that you get with life insurance. Now, there's actually 2 ways to access your cash value. You can withdraw your cash value or you can borrow against your cash value. Now, if you draw your cash value, you don't have to pay any interest on that, but you're essentially surrendering part of your policy as you do that. And life insurance is actually built around a last in, first out. So you actually can draw all your basis before any of your interest. And if you withdraw some of your interest, then you would have to pay tax on that. And so a lot of people withdraw their basis and then take loans against their interest if they want to remain all tax free. But we're going to be talking about the second option to get access to your cash value, which is borrowing against it. And if you borrow against it, you don't have to worry about any of the partially surrendering some of the policies. So the idea is like building cash value, you're getting all the benefits of having a life insurance policy. And then when you want to utilize your cash, you can use your cash value as collateral. The insurance company will then give you an unstructured loan. An unstructured loan simply means they'll just give you a loan with terms that you get to decide when you pay it back. And then you can decide what you want to use that money for. You can buy assets, you can buy liabilities. There's people that buy cars, go on vacations, buy businesses, pay off college debt, buy homes, buy Bitcoins. You fill in the blank. We have clients that have done everything that you could possibly imagine and more with their policy. And the insurance company does not care what you use their policy for. They don't even care how you pay it back because the insurance company has a death benefit, and that's a liability on their books. And they know if you were to die with an outstanding loan, they would ultimately subtract that loan from their death benefit and pay your family or estate the difference. So, for example, if you had $10 million of death benefit and $1 million loan and you died, they would pay $9 million to your estate or to your family. And so they're protected, meaning they can give you unstructured loans at good rates, not requiring you to pay it back because they all ultimately have, you could say, a hedge on your life. And as a result, they can play super long games. Okay, so a common question that we usually get at this time is, okay, why would I use a loan to use my own money? And, technically you're not using your own money because your money's in your life insurance policy. You're getting all the benefits. But to answer that is you would use a loan if you valued what you're getting in benefits in having life insurance more than the cost of the loan. So for example, if it costs me, let's say 7% to access my money throughout my life. And we'll answer the question next when I should take a loan. If I could have access to my money at 7%, I would want to make sure that I value my life insurance policy and the strategy and the portfolio more than 7%. And I just showed you an example of if we included just a few benefits of life insurance, how that easily could be an equivalent to over 8%. Again, the life insurance does not get you 8%, but when you start factoring in some of these other values, a lot of our clients value life insurance at more than 10% at their overall portfolio asset value. So it does not make sense to borrow if you're not actually getting a greater value than what it's costing to borrow. So that's the answer to question number one. The second question is, when does it make sense to borrow? Okay, so I get it that I have all these benefits. I get that life insurance is an asset. I love the fact that I have the option to borrow, and it even makes sense for me to borrow, knowing that my dollars are doing more jobs, and as a result, it's more valuable for me to do it in this scenario. So then the next question is, when does it make sense for me to borrow? And the short answer is when your activity that you're borrowing for is greater than the cost of borrowing, or what we talk about is control cost. So banks do this all the time. If I gave the bank $100 and they gave me 1%, so they essentially gave me $1 for my $100 deposit, and then they loan out my money to someone else for 4%, the ROI that they're making is 300% on that transaction because they're in it for $1. They're loaning my money out, earning 4, and they're making 300% on that transaction. And so the same thing would be like, let's say if your insurance policy has a loan at 5%. Okay. So let's say 5% is the control cost. And you could then take out a loan, 5%, to earn 2%. Your ROI is, congratulations, a negative 60%. So your policy's continuing to do your policy's things, but by you taking out a loan, you're on this activity, now you're getting a negative 60%. And so like we would look at that and say, well, you shouldn't take a loan in this scenario. You would be better off just not taking a loan. Or you could take out a loan at 5% and earn 5 and make 0. So you're taking on more risk. You're losing some capital opportunity. And for what? For 0%. You could take a loan at 5%, earn 7, and from an ROI standpoint, you're earning 40% on that transaction over a year, and that you might choose to do that. You have to factor in risk, and you also have to factor in opportunity costs. By you saying yes to a 7% opportunity, you're maybe not able to say yes to a 12% opportunity or a 15% opportunity. And so this is an example of, would it make sense to borrow mathematically if it cost me 5% to earn 12%? Well, in this scenario, I would earn 140% on that activity over that 1 year. And so this is just a chart to kind of help people understand, when we use policies, we want to make sure that the activity that we're doing is far greater than the cost of borrowing. So when it comes to borrowing, again, it goes to two things. Why would I borrow to use my own money? Well, we already answered that because life insurance gives you so many more benefits and it's so valuable. Then the second thing is, okay, it makes sense to borrow, but just because it makes sense to borrow doesn't mean I should do it for every activity. So I want to make sure that the activities that I do are far greater value than the actual cost that it is to borrow. If you get this right, you can literally give your dollar doing what it's doing in your life insurance policy and what it's doing over here. And that's where you can start creating massive velocity when it comes to your money. And that's where it gets very exciting for entrepreneurial thinkers and business owners and people that are making moves, investing, because they're starting to see, I can make investments, I can get all the benefits of insurance, and I can start investing in such a way that can continue to grow my assets. And so anytime people are saying, I'm worried about losing my money to inflation, or I want to get a better rate of return, if you understand how life insurance works, you can go for that rate of return because you have control and access to your money. Now we're going to talk about the retirement optimizer. So what a lot of people are doing is they're making money, they're putting their money into some type of portfolio. In this case, equities and bonds. And the purpose of this portfolio is to grow, is to have income, is to have liquidity, and to have some type of legacy. So they're putting their money into this portfolio to be able to grow their assets, but ultimately to have income, have liquidity, and some type of legacy in the future. So let's talk about why people use bonds. It's safer than equities. You have some type of diversification. Sometimes you can get some tax advantages when it comes to state tax benefits or municipal bonds. You can have a higher rate of return than a savings account. So that's why people use bonds over savings account. And it can also be leverageable. Even though most people aren't leveraging against their bonds, you can use leverage. Now, the cons to bonds is there's credit and default risk. So it's not risk-free, which is important to know. This is a big one. It can have equity market correlation. So if bonds can be correlated to equities, that can be a really big problem when it comes to planning in the future. We'll touch on that in a second. there's no federal tax advantages, and your contributions going into a bonds are not tax deductible. So those are some of the pros and cons to why people use bonds. But bonds have been used when it comes to retirement planning because of, like we're just saying, it's better than having all your money maybe in just one basket. And so there are a lot of academic research right now. Actually, a lot of these people, Dr. Wade Fowle, Dr. Tom Wall, Ed Slott, like when they're talking about life insurance, they're not talking about life insurance the way that I just mentioned as it relates to using your policy as an entrepreneurial investor to save your money to be able to deploy in other things. They are simply talking about life insurance as a bond alternative. They're looking at a retirement situation and saying, what if bonds would replace with life insurance? Could you get bond-like returns, but get a lot more benefits? And that's their whole thesis. And so if we go back to, instead of equities and bonds, you have equities and life insurance, you have money, you put it into a portfolio, you're with the same idea of growth, income, liquidity, legacy. And we talked about the benefits of life insurance. So we have your pros and cons. And at the end of the day, like this gives you so many other benefits when you actually start thinking about getting potential bond-like returns, but so many other benefits, including a permanent death benefit, including the tax advantages, including the chronic illness rider, which could very much act similar to a long-term care benefit. You have creditor protections. Like it's a private contract. It's a lot safer than bonds. Like you start asking the question, why would people do bonds if they actually could structure a life insurance policy to be a better bond? And you get liquidity, everything that I mentioned before. If you wanted the liquidity to be able to use for another opportunity, you have that as well. All right, there's two key risks when it comes to retirement planning: volatility and longevity. Volatility is like it means because the market goes up and it goes down. Taking money when the market's going up, no problem. Taking money when your market goes down can be very damaging. The other thing is we don't know how long we're going to live. And so if you live to age 85, well, that's one planning time period. But if you live to age 100, that's 15 more years of potential volatility and risk. And so these are two key risk factors that every retirement planner and coach will have to necessarily go through. And so for this reason, that's why the 4% rule is a very common scenario. It's like whatever your portfolio is, you can plan on taking out 4%. You can increase it with inflation, but essentially 4% is the number. And so, for example, if you had $1 million in a portfolio and you took out 4%, you could take out approximately 40 grand. So that's about the 4% rule. Now, life insurance, when set up and used properly, is non-correlated, meaning it's not correlated to the markets. And so you can use a strategy called the volatility buffer. And to make this as simple as possible, we're essentially able to skip years when the market's down, and we can tap into an asset that's not going to go up and down with the market and allow our market to recover. And so if you have 3 to 6 years of skips, you can obviously take out more money because you're eliminating some of the risk of down years in the market. And so studies will show that you can take out, in some cases, a lot more than 4%. I'm using 5.5% just to be conservative, but we're just taking that same $1 million portfolio and we're saying if you had 4 years of volatility buffer, then you could take out more money and have the same amount of certainty of having your money last than the 4% rule. So this is just a pure example. If you have a non-correlated asset, you potentially could take out more money in your stock portfolio without having the risk of running out of money. Another benefit you get with life insurance is you get what's called actuarial science, which is just a fancy way to say life insurance is not just hedges rate risk, but they're also hedging your death, your mortality. And that's actually important because you have contracts and assets that are based around longevity. And so we talked about the two risks, volatility risk and longevity risk. Well, now you have assets that play into that. And so we're using this concept called the covered asset strategy. And what the covered asset strategy essentially means is permanent life insurance is a death benefit that will get paid income tax free upon your death. You have that asset that potentially can unlock other assets that you have that you may not want to spend down, because if you didn't have that permanent life insurance, you may have wanted to have that be something that you pass on, or it potentially allows you to be more aggressive while you're alive, knowing that you're going to leave your spouse or your estate well off. So let me just share an example. A lot of people, when they do annuities, they do what's called a joint annuity. And a joint annuity essentially means if, I and my spouse want to put money into a company, I get a stream of income. And if something happens to me, my spouse will still be able to have that stream of income. And so what we end up doing is we take less than what we could if it was a single payout because we don't want to leave our spouse high and dry. But imagine if I had a permanent death benefit. Imagine if I had a lot of permanent death benefit life insurance. I could potentially take out more money while I'm alive, take more money now, and also know that my asset is covered, that if I die or when I die, my death benefit will get paid to my spouse. So we almost have the best of both worlds. You're able to spend more while you're alive, but also protect that asset and make sure that your spouse is taken care of. That example could be done lots of different ways if you have permanent life insurance, and that's what you get when you have actuarial science. An example of this is, SPIA rates right now are 8%. And so some people could get, $40,000 with half the balance that they would have to use if they did the 4% rule with $1 million balance. So all that to say is there is a lot of different things that are going on. And if I had to summarize just the whole retirement optimizer, it's taking a look at what a lot of people are doing in retirement and saying life insurance in a lot of cases can be a better bond, can give you better protections, give you lots more benefits, can take away some correlation, which gives you optionality, and gives you actuarial science, which gives you optionality. And as a result, there's a lot of people that are using life insurance to optimize their retirement options. And that is something, whether you want to think about retirement or not, like having this as an asset can enhance that. All right, the last case study we're going to get into is the legacy maximizer. This is someone that wants to maximize their legacy. And there's actually this book that I've referenced maybe a few times called What Would the Rockefellers Do? This is written by my good friend, Garrett Gunderson. And I actually wrote the foreword to this book. And everyone who wants a copy, we'd be more than happy to get a free copy to you, showing you the breakdown of how the Rockefeller family used trust and life insurance. Essentially, what they do is every generation that's born into the Rockefeller family, the trust is buying life insurance, and then that life insurance gets passed back onto the trust upon their death. And so it makes sure that every generation has life insurance. They can use their insurance and trust like a bank. But then at the end of the day, when they pass away, the death benefit gets passed back into the trust, and the trust continues to get more powerful. And again, this is a strategy that you're interested in learning more about. We can give you a free copy of What Would the Rockefellers Do, if that's something that you're interested in. So now I want to land the plane, and I want to talk about some of the criticisms and questions. We talked about a lot. I know that it can be overwhelming, and I want to remind you before I get into the criticisms and questions that the number one question that you need to be asking is, could this help me with my situation? The answer is you might not know. There's a lot of things that life insurance can do, and for some of you, you're like, this is absolutely something that I needed. And for others of you, they're like, I'm open-minded. I'm just not 100% sure if this is going to be a fit for me. Stay tuned, because we will show you exactly how to get those answered, and we want to be the company that helps you answer those questions and don't just take our word for it. Like, we'll show you exactly what this could look like in your financial situation. So let me talk about the criticisms and questions. So the first criticism that people will say is life insurance is a horrible investment. Well, we've said over and over and over again that life insurance is not an investment. You should not sell it like an investment. And I would agree that if someone was saying that insurance, even though it gave you lots of dollars more than one job, I would not look at this as an investment, because good investors are able to way outperform in insurance policy. But the cool thing is it can enhance what you're currently doing. The second thing that people will say is life insurance will give you zero cash value early on, and it'll be terrible growth. A lot of times it'll be less than 2%. Well, we just showed that when you set it up properly, you can get a lot more than, zero cash value, and you can get way greater growth than 2%. But in most cases, and over 98% of the policies we see, this is very true. So I have to agree with this criticism, but it's not true across the board. People like Dave Ramsey will say they steal your cash value when you die. And meaning when you pass away, you don't get your cash value and your death benefit, you just get your death benefit. And so if you just hear that, you'd be like, well, that seems unfair. I paid into this thing over time, and then I only get my death benefit. Well, if you notice, the policies that we design, the death benefit are growing far greater than what your cash value is growing. So while that's true, is if you recall, with the overfunded policy that I showed, the initial death benefit was $1.3 million. Over 30 years, that death benefit grew to almost $6 million. So it's true that you only get the death benefit. They do that because of tax reasons. The death benefit is far greater than the cash contributions and the cash value growth. And so this is really a non-factor, but it's something that I want to address because it does come up. People will ask, why would I borrow to use my own money? I think I shared that ad nauseum. The answer to your question is you value your life insurance policy greater than the cost of borrowing. And then the next question would be, you would choose to use your capital if your activity could be greater than the cost of borrowing. So we have to separate your policy from actually borrowing. And there's a world where you can get the benefits of your policy and the benefits of a positive activity over here. All right, number 5, not flexible premiums, and you have to pay till you die. So number 1, you don't have to pay till you die. There's these things called reduced paid up, and you can stop paying essentially whenever you want. After year 7, because there's 7 years that you have to make some type of payment into a policy, you could do what's called a reduced paid up. Lots of different ways to do that. There's pros and cons to that, but essentially your death benefit would drop a lot lower than it originally is, and then your cash value and death benefit would slowly just grow over time, not needing any premium out of pocket. The second thing is your premiums aren't flexible. This might be the case. If you have a typical poorly designed policy, your premiums might not be flexible, but the policies that we design are extremely flexible. And I think it's important that you get flexible premiums. The people say there's big commissions. While this can be true, again, the policies that we design cut the commissions in a fraction because of how we're designing them. And number 7, some people will say, this sounds too good to be true. And again, I've done my best to share with you the why, the how, the what we do. And I tend to agree with you. I mean, there's a lot of people that just hate on insurance, but when you understand all the benefits you're getting with the life insurance, all the benefits, and then you realize that you have access to cash value, and in a few years, you are actually going to have more cash value than what you put in, and your death benefit is growing, and that gets paid out to your estate or to your family. It does feel like a pretty amazing place. And that's why myself and many of the people that we serve, that's why we have over $2 billion of this stuff set up for our clients, because it's been something that when set up and used properly, it can be amazing. All right, as we wrap up this masterclass, the key question that you should be asking yourself is, does this help me live more intentionally? I opened up this whole presentation by saying, if this doesn't help you better your financial situation, or if this doesn't help you live more intentionally, it doesn't matter how many jobs you can give $1, you shouldn't do this. But if you're someone that's like, I'm open, maybe this will make my situation better. I think this could make my situation better, but I don't know because I need to see how this integrates with what I'm currently up to. Well, then I want you to schedule a discovery call with our team. The discovery call is exactly what it's called. It's a discovery of what you're currently doing, and we're trying to answer the question, is life insurance going to actually better your financial situation? And for many of you that do the discovery call, we'll actually be able to show you firsthand with your numbers how life insurance can enhance and better your situation. And for some of you that go through this, we might be able to show you, hey, life insurance is actually not the thing that you should be focused on. It's not going to better your financial situation. And we'll make sure to tell you at any time when we realize that permanent life insurance is not the right fit for you, we'll let you know. And for those of you that want life insurance, our team is world-class, and not just setting it up properly, designing it properly, but servicing you along the process of not just getting it, but as you have it the rest of your life. And so if this is something that you want to learn more about, or you're open to at least seeing what your numbers could look like, schedule your discovery call, and we would be absolutely honored to serve you along your journey.